add to any of that in terms of budget implications specifically today?
Well, it's interesting that since 2000, actually the day after the budget has been quite a positive one for the Aussie share market. In fact, in the last 13 years, we've actually only seen decreases on the market in 4 of those years. So generally, it is a positive session if we have a look at the statistics. In terms of the budget impacts, I have to agree that there's not a huge amount. The biggest impact is in terms of infrastructure, which of course benefits those engineering contractors. So $24 billion worth of spend over 5 years. Also, there's some slight negative impacts as well. If we have a look, biotech companies may be slightly impacted. We do see limits to research and development incentives as flagged, and this really affects companies with turnover of less than $20 billion here in Australia. Another impact that we're watching is the pharmaceutical benefits scheme, where we do see a freeze until 2014, so that might be a slight negative for primary healthcare. But of course, with the Aussie dollar declining on the back of hopes that we will see more interest rate cuts, in fact the market now pricing in a 70% chance of another cut, we are going to see those companies which are exposed to overseas earnings being impacted positively. So that's the likes of QB Insurance, News Corporation, Brambles, all doing quite well on the back of the Aussie dollar weakening story.
All right. I think we'll probably leave budget stuff there. Let's go on to CBA, because this is, on any other day, this would have been the top story. Credit Suisse has put out a note, and they've said that the third quarter numbers from CBA point to bank earnings downturn. They're saying that the trading update suggests the optimisation of bank earnings is reaching its limit. A couple of other comments there. The result was supported by a cyclically low bad debt charge, and so was the lower quality than hoped in terms of that score. And with bad debt charges as feasibly low as they can get, margin expansion and the pace of productivity improvements are fading. Julia Lee?
Well, if we have a look at where a lot of the bank's profitability has come from and the net margin increase, it is on the back of repricing home loans. And with the banks now under pressure to pass on all of the Reserve Bank cuts, if not more, we're not going to see much of that flow on through. So it's a very strong result coming through from CBA. Nothing seems to be stopping it at the moment. Things are really going in its favour. We have a look at this cash profit result, $1.9 billion. That compares to $1.75 billion in the previous period. Net interest margins increasing, as I mentioned. That's really on the repricing of the home loan products that we've seen over the quarter, with Commonwealth Bank not passing on the full rate cut. But of course, going forward now, that's going to be a more difficult strategy to implement. We have a look at the key areas, the retail space. Well, we know that the repricing in home loans has been a positive, and we've seen moderate credit growth there as well. But in the area of commercial, its commercial business, it's a much more difficult space where we are seeing very low credit growth. And then if we have a look at its wealth management or funds under management, up by 4%. So an extremely strong result. And I guess the question is, well, where are we going to see the improvements now going forward? Because we have seen a lot of things moving in the favour of the banks. But altogether, if you're buying into CBA, really you're buying into a leverage play on the Australian economy. And I guess if we have a look at the big 4 banks, both CBA and Westpac differentiate themselves because of the focus on the their domestic business here in Australia.